For years, it felt like you could set your watch to Bitcoin. It seemed to move like clockwork, driven by this predictable, repeating four-year pattern that investors literally set their calendars by. But what if that clock is broken? Today, we're going to dig into the growing evidence that one of Bitcoin's oldest, most foundational stories might actually be coming to an end.
So let's just get right to it. The big question, the one that changes everything, is simple but honestly pretty profound. Is the legendary four-year cycle over? For a lot of people in this space, that idea is practically heresy. But the data is starting to point to a massive shift in what's really driving the market.
Okay, so to really get why this is such a huge deal, we first have to go back and understand the old story. Let's take a look at the mechanism, the engine that created this legendary predictability in the first place.
At the very heart of this cycle is an event called the halving. It's literally hard-coded into Bitcoin's DNA. About every 4 years, the amount of new Bitcoin being minted gets sliced right in half. This creates a supply shock, right? And that shock has historically been the starting pistol for the entire race.
And this is what that clockwork looked like. It was beautiful in its simplicity. The halving kicks things off, then boom, about a year and a half later, you get a massive run-up to a new all-time high. Then, of course, comes the crash, the bear market, followed by a slow and steady recovery, just in time for the next halving to do it all over again. It was so regular, people treated it like a law of physics.
But here's where it gets kind of wild. There's this fascinating concept that the cycle may have worked, at least in part, because everyone believed it would work. It's called a hyperstition. Think about it. If enough traders believe the price is going to peak in November, what do? They start planning to sell in November, and in doing so, they create the very peak they were expecting. It was an incredibly powerful, self-fulfilling prophecy.
But that shared belief, that collective story, it's starting to crumble. The old narrative just doesn't seem to fit the new reality. So let's look at the major cracks that are now appearing in this long-held theory.
First off, let's be real. We're talking about an asset that's not even 20 years old. We've only had a few of these cycles. Is that really enough data to prove a pattern with any real certainty? Probably not. On top of that, you've got this flood of new investors coming in who, frankly, don't know and don't care about the old lore. But the biggest reason of all, the math has just fundamentally changed.
And this right here, this chart shows the new dynamics so clearly, it's kind of shocking. After the last halving, miners are creating about 450 new Bitcoin a day. Okay, but institutional demand, driven by things like the new ETFs, is soaking up around 4,500 Bitcoin a day. That's 10 times more demand than new supply being created. It's not even close.
So here's the absolute takeaway from that. When demand is already outpacing new supply by a factor of 10, cutting that tiny sliver of new supply in half again is, well, it's almost a rounding error. The supply shock from the halving, the very engine of the old cycle, has become, as the source material puts it, inconsequential.
Okay, so if the halving isn't in the driver's seat anymore, what is? If it's not Bitcoin's internal clock, then what is setting the pace? Well, the answer isn't in Bitcoin's code. It's in the global economy.
And this just lays it out perfectly. It is a true changing of the guard. We're moving from a world where Bitcoin's price was driven by its own internal supply schedule to a totally new world where it's being driven by massive, external, macroeconomic forces, specifically global liquidity cycles.
The source we're looking at uses the perfect analogy for this. It's no longer the tail wagging the dog. For years, Bitcoin's little halving was the tail wagging the entire market. Now, the massive dog of global capital, of global liquidity, is wagging the much, much smaller tail of Bitcoin's price. When central banks turn on the money primers, that capital has to flow somewhere.
And the proof is literally everywhere you look. We're in what people are calling an everything rally. I mean, think about it. Safe havens like gold and silver are pushing all-time highs. But at the same time, so are super risky assets like fringe tech stocks. When everything is going up at once, it's not about the individual asset anymore. It's about a massive tide of capital that's just lifting all the boats.
So, how are the folks on the absolute front lines of Bitcoin's economy, the miners, dealing with this new reality? They're not just sitting back and watching this happen. No way. They are actively and very cleverly adapting.
There's this great old proverb that just perfectly captures what the miners are doing. They can't stop the halving from happening, and they certainly can't control global macro trends. But what they can do is be incredibly strategic about how they run their businesses in response to that wind.
And here's their playbook. They are being super thoughtful about their big expenses, planning infrastructure costs years ahead of the next halving. They're constantly running the numbers on this really interesting question.
Is it smarter for us to invest in new mining hardware, or should we just take that capital and buy Bitcoin directly? And most importantly, they're looking beyond the block reward to a whole different source of income: transaction fees.
Now, this focus on fees isn't just a short-term trick to survive the next halving. It points to the fundamental evolution of Bitcoin's entire economic model and its grand plan for long-term survival.
See, miners really have two income streams. You've got the block subsidy. That's the reward for creating a block. That's the old pillar, and it's designed to shrink and shrink until it's gone. Then you have the new pillar, the one that's supposed to support the network forever, the fees people pay to get their transactions processed.
And if you look far enough into the future, the whole model is designed to completely flip on its head. The vision is for that small, shrinking block subsidy to be more than replaced by a robust, growing market for transaction fees. That fee market is meant to become the dominant source of revenue from miners.
So why does any of this matter to you, even if you're not a miner? Because that revenue, all that miner income, that's Bitcoin's security budget. It's what pays for all the computing power that keeps the network decentralized, honest, and safe from attack. For Bitcoin to actually survive for the long haul, that transaction fee revenue has to grow. There's no other way.
So, if the predictable, clockwork, 4-year cycle is a relic, a story from Bitcoin's youth, it leaves us with one last fascinating question. What comes next? Are we entering a longer, less predictable supercycle that's driven by the whims of global economics? The only thing that seems certain is that the old map doesn't work anymore.